Welcome back to the Deep Dive, the place where we don't just summarize sources, we perform forensic analysis, giving you the critical insights you need fast.
And today we are taking a legal core sample of corporate integrity.
That's right, we are diving deep into the rulebook that governs the fundamental watchdogs of the corporate world, the auditors.
Our focus is Chapter X of the Companies Act 2013, which spans sections 139 to 148. This legal framework is really the foundation of financial accountability in India.
And our mission today is not just to recite these statutes, but to really understand the regulatory philosophy behind them.
Exactly. Think of this as a masterclass designed to show you why these rules exist, how they enforce independence.
And what regulatory firewalls are built in to prevent the next major corporate fraud.
Right. We'll unpack everything from mandatory rotation rules and the severe limits on an auditor's personal finances.
All the way to the two-tiered system for whistleblowing on fraud. We'll use practical examples to turn what can be pretty dense legal text into crystal clear knowledge.
We're going to explore the whole system, the one designed to make the auditor a fearless, independent professional.
So we're covering everything from the standard appointment process to the strict limits imposed by the National Financial Reporting Authority.
And by the end, you should have a step-by-step grasp of the powers, duties, and the very severe consequences governing this crucial office.
Let's start at the absolute beginning then, the foundation, the auditor's core role. If management is preparing the financial statements, why can't shareholders just trust the director's signature?
Well, it really boils down to the inherent agency problem and, of course, the conflict of interest.
Okay.
Management, the directors, they're the agents hired by the owners, who are the members.
Right.
And the directors are incentivized to present the most favorable picture possible. That can lead to aggressive accounting or, in the worst case, outright fraud and mismanagement.
So the auditor is the check on that.
The auditor is the independent professional opinion appointed by the members to stand between management's presentation and the owner's assessment.
And their job is to confirm whether the financial statements reflect a true and fair view.
Precisely. Independence isn't optional here. It is the entire basis of their fiduciary trust.
And the law begins to secure that independence right away with rules on how long they can even stay in the job. What's the standard term for a subsequent auditor under Section 139?
So the standard tenure is a 5-year block. An auditor, once they're appointed at an annual general meeting, an AGM holds office from the conclusion of that meeting until the conclusion of the 6th subsequent AGM.
Oh, it's a recurring cycle.
It's a recurring cycle.
Right.
They are eligible for reappointment for subsequent terms, always capped by that 5-year cadence, unless they fall under the mandatory rotation requirements.
Which we will definitely get to.
Oh, yes.
But to make that cadence clear, walk us through a basic timeline. Let's use example 1, Rochelle Tech Labs Private Limited.
Okay, so imagine Rochelle Tech Labs was incorporated recently, say 2023-24. Their first AGM is held on September 30, 2024.
Got it.
If a firm, let's call them Ms. Ramsden Associates, is appointed as the subsequent statutory auditor for 5 years at that meeting, their tenure begins right then and there.
And they hold that post for 5 full financial years.
Exactly. They'll audit the books for 5 years and hold office until the conclusion of the 6th AGM, which would be in the year 2029.
So that fixed 5-year term provides stability, but it also ensures a mandatory renewal of faith from the members.
That's the idea.
Now, for larger companies, especially the listed ones, the board doesn't just, pick a name out of a hat. The decision involves a highly specialized corporate governance body, the Audit Committee.
Correct. The Audit Committee's role, which is governed by Rule 3 and references Section 177, is arguably the most critical initial filter for auditor selection.
It's a layer of experienced, independent director oversight.
It absolutely is, and it's put right at the start of the process.
So which specific public companies are legally required to have this Audit Committee? This seems like a key regulatory trigger.
It is. The mandate is triggered by size and public interest. So every listed public company must have one. No exceptions.
Okay, that's simple enough.
Beyond that, there are financial thresholds that apply to other public companies based on their last audited financial statements.
And what are they?
First, if the paid-up share capital is 10 crore rupees or more.
Okay.
Second, if the turnover hits 100 crore rupees or more. And third, if the aggregate outstanding loans, borrowings, debentures, or deposits, basically the public money risk exceeds 50 crore rupees or more.
So if you hit any one of those 3, the AC is mandatory.
You hit one, and you're in.
What exactly is the audit committee's job when they're vetting a potential auditor? They aren't just rubber stamping a recommendation, are they?
Oh, far from it. Their duty is comprehensive. They have to assess the auditor's qualifications, their professional experience, their fitness.
To make sure they can actually handle the job.
Right. To ensure the firm's capability is commensurate with the sheer size and complexity of the company being audited. And crucially, they are legally obligated to check for any pending disciplinary or professional proceedings against the proposed auditor.
So things from the Institute of Chartered Accountants of India or any court.
Yes, any of it. They are performing a very serious, upfront quality control check.
This sounds like a system designed for a bit of tension. What happens if the board of directors disagrees with the audit committee's recommendation? I mean, that corporate governance flashpoint is precisely where independence gets tested?
That procedural friction is intentional. It's built into the system. If the board disagrees, let's take example 2, Surya Solar Limited. The board can't just override the AC.
What do they have to do?
It must refer the matter back to the audit committee for reconsideration, and it has to provide detailed reasons for its disagreement in writing.
So the AC gets a chance to stand its ground or revise its view?
Precisely. If the audit committee reviews the board's critique and still decides to stand by its original recommendation, then the board has to record its final reasons for disagreement and send its own preferred recommendation, the one it wants the members to consider, to the members for the upcoming AGM.
So the members get the final vote, but they also get the full story.
They get a full documented account of the disagreement between the AC, which is the independent oversight body, and the board, which is the management. It's all about transparency.
Okay, so once the selection is made, there's some mandatory paperwork that locks the auditor into legal accountability. That's defined in Rule 4.
This is the legal initiation phase. Before the appointment is finalized, the company has to get 2 things from the auditor: their written consent and a formal certificate.
And that certificate is basically the auditor's solemn declaration of compliance.
It is.
What are the non-negotiable points the auditor must confirm in that certificate?
They confirm that they are eligible and not disqualified under either the Companies Act or the Chartered Accountants Act. They have to confirm compliance with the strict term limits, the rotation rules, and that their appointment falls within the maximum ceiling limits, which is the 20-company rule.
Right.
And finally, they must certify that the list of any pending professional proceedings they've disclosed is true and correct. If they lie here, the legal consequences are severe from day one.
And there's one last step for the largest, most strategically important companies. It involves informing the superregulator, the National Financial Reporting Authority, or NFRA.
Yes, NFRA oversight is fundamental. It really reflects the post-scam focus on regulatory enforcement. Rule 3.2 of the NFRA rules, 2018 dictates the timing.
How so?
Any existing body corporate already governed by NFRA rules must inform NFRA within 30 days of the commencement of those rules, using Form NFRA 1.
And for new companies that fall under NFRA's watch?
For newly governed entities, they have to inform NFRA within 15 days of the auditor's appointment under Section 139.
So NFRA has immediate visibility over who is auditing the top layer of Indian corporate power.
Immediately. They want to know who is minding this store from the very beginning.
Let's move to what you mentioned earlier, the most powerful statutory weapon against auditor complacency: mandatory rotation. This is literally the law saying you cannot get too comfortable.
This is the critical independence guardrail, and it's all covered by Section 139(2) and Rule 5. The law recognized that even the best auditor, after, say, 15 or 20 years with the same client,
Can become overly familiar.
exactly, leading to blind spots, or worse, complicity. Mandatory rotation is designed to break that cycle.
So let's nail down which companies are subject to this intense level of regulatory supervision.
It starts with all listed companies, regardless of their size. Then it sweeps in other large public and private entities.
It excludes one-person companies and small companies.
Right. The thresholds are designed to capture systemic risk. So 1, unlisted public companies have to rotate if their paid-up capital is 10 crore rupees or more.
Okay.
2, private limited companies must rotate if their paid-up capital is 50 crore rupees or more.
A much higher threshold for private companies.
Much higher. And 3rd, any company, public or private, that has public borrowings or public deposits of 50 crore rupees or more.
Those thresholds make it very clear the focus is on companies handling large amounts of public money, whether it's through shares or debt.
That's the logic.
So once rotation applies, what are the maximum tenure limits?
It depends on the structure. An individual auditor gets only one term of 5 consecutive years. That's their maximum run.
And for a firm,
An audit firm gets 2 terms of 5 consecutive years, which totals to 10 consecutive years maximum.
and then comes that non-negotiable cooling period. This is the enforced separation designed to reinstitute objectivity.
Absolutely. Once that maximum term, 5 years for an individual, 10 for a firm, is completed, they are barred from being reappointed as the auditor for that company
For how long?
for a period of 5 years from the completion date. This 5-year cooling period is completely non-negotiable.
Let's use the firm scenario from example 6. Emma's Raghavan Associates audits XYZ Ltd. for 2 consecutive terms from 2016 through 2026.
Okay, so they hold office until the conclusion of the AGM in 2026. Having completed that full 10-year tenure, they are immediately ineligible.
And they have to sit out for 5 years.
They have to sit out the subsequent 5 years and cannot be reappointed until the AGM in the year 2031. This is the mechanism that ensures the company gets completely fresh eyes after a decade.
But what about the common partner loophole? Regulators must have anticipated that firms might try a corporate shell game, shifting key people to a related firm to continue the engagement.
Oh, they shut that down explicitly. The law prohibits an audit firm from being appointed if they have any partner who is partner in the audit firm whose tenure has just expired.
So the cooling period applies to the individuals who drove the audit.
Yes, not just the name on the door.
Example 7 illustrates this perfectly. Mrs. Krishna Associates finishes its tenure in 2026. Mr. Shyam is a partner there. Mr. Shyam is also a partner of Ms. Kukreja and Associates. So can Kukreja and Associates step in for the 2026 appointment?
They cannot.
Yeah.
Because Mr. Shyam is the common partner connecting the two firms, Kukreja and Associates is barred from appointment until 2031.
That's a deep cut from the regulators.
The intent is deep. If the same experienced individual is still signing the report, the purpose of rotation has been defeated, even if the new firm has a different letterhead.
Now, the members themselves have some power regarding how rotation occurs, which is detailed in Rule 6.
They do. The members have the right to resolve 2 key things. First, they can mandate the rotation of the auditing partner and the team within the firm at prescribed intervals.
So even if the firm has time left on its term, the people can be cycled out.
Exactly. Second, they can resolve to appoint more than one auditor, which means having joint auditors.
If the company does use joint auditors, how does the rotation rule apply to them?
Rule 6.4 mandates staggered rotation. If you have 2 firms as joint auditors, the rotation schedule has to be designed so that both or all of the joint auditors do not complete their maximum terms in the same financial year.
That ensures auditing continuity.
Right. You always have at least one experienced firm remaining while the other rotates out.
We should also address the complexities from when the Companies Act, 2013, first took effect, the transitional period accounting. How was tenure calculated for firms that had already served for many years?
This is crucial for historical context. Rule 6.3 explicitly said you couldn't just hit a reset button.
So you had to count the years served before the new act.
When calculating the 5 or 10 consecutive years for compliance, the period served prior to the commencement of the 2013 Act must be counted. The law did provide a 3-year transition window for existing auditors to align with the new, stricter rotation requirements.
So a large firm had already audited a client for, say, 8 years before 2013. They didn't get a new 10-year term.
No, not at all. If they had served 8 years, they had 3 more years in that transition period to find a replacement. They would have hit their mandatory rotation after 11 years total.
And if they had only served 2 years?
Then they still had 8 years remaining to complete the 10-year limit, plus that extra 3-year transition period adjustment. The table in the source material clearly shows the intent was not to disrupt audits overnight, but to enforce the rotation within 3 years.
Okay, let's pivot now to the start of a new company's life. Appointing the first auditor for a non-government company under Section 139(6).
This initial appointment is a management function. The board of directors must appoint the first auditor within 30 days of the company's registration.
And that auditor holds office for a very short period.
Very short and very specific, until the conclusion of the first annual general meeting, AGM.
And what if the board misses that initial 30-day window?
If the board fails, the appointment responsibility shifts immediately to the members. The board has to inform the members, and then the members must make the appointment at an extraordinary general meeting, an EGM, within the next 90 days.
Illustration 2 highlights a common error here. Unicorn Steel Private Limited's board appoints Jane Ujmera and Associates as the first auditor for a term of 5 years. Is that 5-year term valid?
It is legally invalid. The board can appoint the first auditor, but Section 139(6) overrides any resolution attempting to set a longer term.
So the first auditor, by definition, only serves until the first AGM.
That's it. A subsequent auditor has to be appointed then, following the standard 5-year rule.
Now let's cover the unique process for the auditor of a government company. Given the state's ownership, who oversees this?
The oversight belongs to the Comptroller and Auditor General of India, CAG. This is a critical distinction because the CAG represents the public interest in these government-controlled entities.
So for the first auditor of a government company, Section 139(7) mandates a CAG to act quickly.
Very quickly, the CAG appoints the first auditor within 60 days from the date of registration.
And if the CAG fails?
Then the board gets the next 30 days. If the board fails, the members get the next 60 days at an EGM. But regardless of who appoints them, the tenure still ends the conclusion of the first AGM.
What about the subsequent auditor of a government company under Section 139? Does the CAG retain control?
For all subsequent years, yes, the CAG retains control. The CAG must appoint the auditor within 180 days from the commencement of the financial year.
And the term is shorter.
Much shorter. Unlike non-government companies where the tenure is usually 5 years, this auditor holds office only until the conclusion of the annual general meeting. It's a recurring annual appointment by the CAG.
We've covered how auditors get in and how long they stay. Now let's define the hard boundaries, the legal definition of independence. We're jumping to Section 141, eligibility, qualifications, and disqualifications, because if you fail here, the entire foundation just collapses.
This is the firewall section. The law first establishes the professional requirement. An individual auditor must be a chartered accountant in practice.
And for a firm?
For a firm, the majority of practicing partners in India must hold that qualification. And only those CA partners are authorized to act and sign on behalf of the firm.
The real substance, though, is in the detailed disqualifications under Section 141(3). These are designed to eliminate any real or perceived conflict of interest. Let's start with conflicts related to employment.
Disqualification C is very straightforward. You cannot audit the company if you or your partner is an officer or employee of that company.
The roles are mutually exclusive.
Completely. The auditor is an independent check, the manager as the preparer. You can't be both.
And this triggers the instant vacation rule we talked about, right? Section 141.
Exactly. If Mr. Anil, a CA, partners with Mr. Virat, who is the manager of finance of Laxman Ltd., Mr. Anil's firm immediately incurs that disqualification.
And the office is automatically vacated.
Instantly.
Oh.
It's a firing enforced by the statute, which then creates a casual vacancy.
Now we get to the financial conflicts, specifically holding securities or interest. This provision is notoriously strict.
This is the zero-tolerance standard that the 2013 Act brought in. For the auditor or their partner personally, they are disqualified if they hold any security or interest in the company or its group entities.
Group entities meaning subsidiary, holding, associate, or fellow subsidiary.
A whole group.
And just to underscore how strict this is, the old law allowed a small holding, I think it was 1,000 rupees. What's the limit now?
The current limit for the auditor or partner is 0. Not a single rupee of security or interest is permitted. Illustration 7 confirms this perfectly. Mr. Ashish, holding just 900 rupees worth of securities, is immediately disqualified.
That shift really signals that the regulator is no longer concerned with just material conflicts.
We're concerned with any perceived influence, regardless of the value.
But the auditor's relative gets a tiny margin of error.
Yes, a very small one. The relative is allowed to hold security of face value, not exceeding 1 lakh rupees. That's the legal tripwire.
And it's crucial that this 1 lakh threshold applies to the aggregate holdings of all relatives combined, right?
That's a key point. It's not 1 lakh per relative, it's 1 lakh total for all of them together.
Okay, let's use the illustrations to lock this in. In illustration 8, Mr. P's relative holds 90,000 rupees. Is that acceptable?
That's acceptable. 90,000 is within the 1 lakh threshold, so Mr. P remains qualified.
In illustration 9, the firm BC & Co.'s partner has a relative holding 1,10,000 rupees in securities.
Disqualification is triggered immediately. That 10,000 rupee excess pushes the partner, and therefore the firm, out of the office.
So the logic is that holding over 1 lakh, even by relative, creates enough financial interest to compromise objectivity.
That's the regulatory line in the sand.
If a relative crosses that threshold after the auditor is appointed, is there any kind of grace period?
Yes, the law recognizes that you can't always control your relative's investment decisions. It grants a 60-day window.
To fix it.
Right. The auditor must take corrective action, selling off the excess securities, to bring the relative's holding back below 1 lakh within 60 days of the acquisition. If they fail, disqualification under Section 141 applies.
Next, financial dependence. Indebtedness. What are the limits on owing money to the client?
Disqualification F applies if the auditor, partner, or relative is indebted to the company or its group entities in excess of 5 lakh rupees.
So if Mr. Ramesh owes MNP Ltd 6 lakh, he's disqualified.
He's out.
And what about guaranteeing a third party's debt? The limit here is surprisingly tighter.
Disqualification G is crucial because a guarantee introduces external pressure. If the auditor, partner, or relative provides a guarantee or security for a third party's indebtedness to the company exceeding 1 lakh rupees, they're disqualified.
That's interesting. So you can owe the company up to 5 lakh yourself, but guaranteeing someone else's debt is seen as a higher risk.
It is. The logic is that the pressure from that third party could be more influential, so the limit is much tighter.
The rule also prohibits a business relationship. How does the law distinguish a prohibitive commercial relationship from just being a regular customer?
A prohibited business relationship is defined as any transaction for a commercial purpose, but with 2 critical exceptions.
Okay.
The first is professional services explicitly permitted under the Act. The second and more practical one is transactions conducted in the ordinary course of business at an arm's length price.
So if I audit an airline, I can still buy a ticket from them.
Exactly. Or if you audit a software company, you can buy their standard software package. Buying a service or product available to the general public at the standard price doesn't compromise your independence.
Another key check is whether the auditor's relative is a director or KMP.
Disqualification prevents the appointment if the auditor's relative holds the position of a director or key managerial personnel in the company. The focus is on controlling interests.
And illustration 6 clarifies that a spouse working as a storekeeper does not trigger this.
Correct, because that role is neither a director nor a KMP.
Let's move to the ceiling limit on audits, the mechanism designed to ensure quality control and prevent overcommitment. This is the 20-company rule.
Right. Section 131(3)(k) strictly states that an individual person or partner is disqualified if they hold appointments as auditor of more than 20 companies.
This is an individual capacity limit.
It is. It's designed to prevent audit partners from spreading themselves too thin.
And what companies are deliberately excluded from that 20-company count?
The law grants exceptions for smaller entities. One-person companies, small companies, and private companies with paid-up capital less than 100 crore rupees.
But there's a catch for those private companies.
A very important one. The exemption is contingent on them not being in default of filing their financial statements or annual returns. Compliance is the price of the exclusion.
Illustration 10 gives us the math. If ABC & Co. has 3 partners, the firm's total capacity is 60 audits. If partners A, B, and C hold 4, 6, and 10 audits respectively, what's the remaining room?
So collectively, they've taken 20 audits. The firm still has 40 more audits available.
But the limit is always enforced individually.
Always. Mr. A cannot take 20 more audits, even if the firm has the capacity, because his personal maximum is 20 total. This duality firm capacity and individual partner limits is critical.
Okay, 2 final integrity disqualifiers before we look at the services that are banned.
Disqualification L is straightforward.
Duh.
You're out if you've been convicted of fraud and 10 years have not elapsed since that conviction. And M serves as a link to our next point. You're disqualified if you're rendering any service referred to in Section 144, the prohibited services list.
That sets us up perfectly for the ultimate firewall against self-review. Prohibited non-audit services under Section 144. If an auditor performs these functions, they are essentially auditing their own homework.
The law here is completely uncompromising. The auditor, their firm, or any associated entities are banned from rendering 8 specific non-audit services.
And that's directly or indirectly to the client company or its group entities.
Right. The goal is to keep assurance, the statutory audit, completely separate from management, which includes advisory and operational roles.
So which 8 services are explicitly banned?
Okay. The list is 1. Accounting and bookkeeping services. 2. Internal audit. This is the classic example of auditing your own work.
Of course.
3. Design and implementation of any financial information system. 4. Actuarial services. 5. Investment advisory services.
Right.
6. Investment banking services. 7. Rendering of outsourced financial services. And finally, 8. Management services.
Let's focus on that third one, the design and implementation of a financial information system. Why is that specifically banned?
Because if the auditor designs the entire IT backbone and the internal controls within that system, they lose all objectivity when they later come back to audit those very controls for effectiveness.
Illustration 7 confirms this.
It does. If the auditor accepts the job to implement a financial information system, that act alone triggers immediate disqualification and exposes them to penalties under Section 147.
And the regulatory definition of directly or indirectly is broad enough to catch any clever attempt at circumvention, I assume.
It is designed to be comprehensive.
Yeah.
It covers the individual, the firm, any parent or subsidiary entity, any person under their significant influence, or any entity that uses the auditor's name or brand.
So a major audit firm can't just set up a sister concern with a slightly different name to do the internal audit.
No. The firewall applies across the entire professional ecosystem.
The auditor, having established independence and accepted the job, is entitled to compensation. Let's clarify remuneration under Section 142.
For subsequent auditors, the remuneration is fixed by the members in the general meeting.
And for the first auditor?
For the first auditor, the remuneration is fixed by the board of directors since they were the appointing authority.
What elements are included in the legal definition of remuneration?
It covers the audit fee, any out-of-pocket expenses that are specifically for the audit, like travel, and any facility extended to them.
And what does it exclude?
Importantly, it excludes payments for any other non-audit service requested by the company.
We've established the strict legal limitations on their appointment, but what about their powers? Section 143(1) seems to grant them unprecedented access.
The power has to match the duty. The auditor has the right of access at all times to the books of accounts and vouchers, wherever those records are physically kept.
They don't have to ask permission.
It is a statutory right. They are also entitled to demand any necessary information and explanation from the company's officers. Refusal to provide these is a serious contravention of the Act.
And their access extends beyond the company being audited, specifically to its group structure.
It does. If the audited company is a holding company, its auditor has the right to access the records of its subsidiaries and associate companies.
But only for a specific purpose?
Yes, only to the extent necessary for the consolidation of financial statements. You can't consolidate accounts without verifiable data from the entire group.
Section 143(1) also outlines 6 mandatory matters of inquiry. These aren't things the auditor might look at. These are specific high-risk areas they shall inquire into.
And they often target potential director abuse. These inquiries are designed to expose common internal schemes. Like loans and advances, making sure secured loans are properly secured. Book entries, verifying transactions that are just on paper, aren't prejudicial.
What else?
Sale of investments, to confirm assets weren't sold below cost to a related party. Checking for disguised loans classified as deposits. Making sure personal expenses aren't charged to the company.
And finally,
verifying that cash for shares was actually received when shares were allotted for cash.
these inquiries form the backbone of the auditor's opinion, which is formalized in the auditor's report under Section 143(2) and 3, and the opinion must attest to whether the accounts give a true and fair view.
The report is where all the duties culminate. Beyond the true and fair view, they have to confirm they received all necessary information, that proper books were maintained, that the financials agree with the books, and that the company complied with all applicable accounting standards.
But the report also includes modern corporate governance requirements, like the status of directors and internal controls.
Exactly. They must report if any director is disqualified under Section 1C4(2). And critically, they have to report on the adequacy of the company's internal financial controls, IFC, and confirm their operating effectiveness. This is a massive area of focus post-2013.
Moving beyond just numbers to the systems themselves.
System verification, absolutely.
Rule 11 extends this duty further, prescribing additional reporting matters that often seem designed to catch systemic risk or fraud pathways.
Rule 11 focuses on risk exposure and regulatory compliance. It requires views on the impact of pending litigations, provisions for material foreseeable losses, and any delay in transferring funds to the Investor Education and Protection Fund.
The most complex requirement here is the check on intermediaries and ultimate beneficiaries. This sounds like the regulators trying to mandate the tracing of corporate money laundering or circular funding schemes.
That is precisely the goal. The law forces the auditor to verify that management hasn't used a complex series of transactions, sending funds to intermediaries, with the unspoken understanding that those intermediaries would then route the money to a third party.
The ultimate beneficiary.
Exactly. It's a mechanism to unmask hidden lending or investment schemes and prevent illegal parking of corporate assets.
And the newest, most forward-looking requirement tackles digital integrity. The audit trail, edit log facility.
This is a major regulatory response to how easily digital records can be altered. For financial years starting on or after April 1st, 2022, the auditor has to report whether the company's accounting software has an audit trail facility that captures every change.
Who made it and when?
Yes, the auditor must confirm this feature operated throughout the year, was not disabled, and the logs have been preserved. This fundamentally elevates digital accountability.
We mentioned IFC reporting. Do small companies have to comply with that complex requirement?
No, the law grants exemptions to prevent undue compliance burden on small enterprises. The IFC reporting requirement doesn't apply to one-person companies, small companies, or any private company with a turnover of less than 50 crore rupees and aggregate borrowings of less than 25 crore.
But just like the 20-company rule, these exemptions are contingent on the company being compliant with its filings.
Always, compliance is the key.
Let's address the most serious duty. Fraud reporting obligations under Section 143(12) and Rule 13. The auditor is mandated to be a whistleblower, and the procedure is tied to the monetary size of the fraud.
The threshold is strict, 1 crore rupees. If the auditor believes a fraud involving 1 crore or more has been committed against the company, the report goes immediately to the central government.
To the Ministry of Corporate Affairs.
That's right.
What are the procedural gymnastics required for this major fraud reporting? The timeline seems intense.
It is a 4-step sequence designed to ensure management is informed but cannot suppress the information.
Step 1.
1. The auditor must report to the board or audit committee within 2 days of discovery, asking for a reply within 45 days.
Okay.
2. If they get a reply, they must forward their report, the reply and their own comments on that reply, to the central government within 15 days.
And if they get no reply?
If there's no reply after the 45-day deadline, they must report the lack of response immediately to the central government, detailing the lack of cooperation.
And the final step is filing the form.
Yes, the final report is filed in Form ADT4 via sealed, registered, or speed post and confirmed by email.
That system uses friction and strict timelines to force transparency up to the highest regulatory level. For fraud less than 1 crore, the reporting remains internal, correct?
It does. For smaller frauds, the auditor reports to the audit committee or board within 2 days.
And that information doesn't go to the central government.
Not directly from the auditor, but the board then has a legal duty to disclose the incident in detail within its own report to the shareholders.
And the critical question, is the auditor protected if they perform this whistleblowing duty?
Absolutely. Section 143 of 13 grants protection, stating that reporting fraud in good faith is explicitly protected and is not considered a contravention of any duty. It's meant to reduce the fear of retaliation.
And if the auditor fails to comply with this complex fraud reporting procedure, the penalty is severe.
The fine is 5 lakh rupees for listed companies and 1 lakh for any other company. There's a steep cost for failing to follow the process.
Illustration 12 provides a critical nuance. What if the management finds and reports the fraud first?
The auditor is only mandated to report directly to the central government if they are the first person to discover or note the fraud in their professional capacity.
So if management has already reported it, the auditor doesn't duplicate the report?
Typically, no. Their duty is then reduced to noting the matter appropriately in their audit report, for example, in CRO, but they don't send a separate ADT4.
Let's shift quickly to branch audit, Section 143(8). Can a foreign branch be audited by someone who isn't a qualified Indian CA?
Yes. For a branch in India, it has to be audited by the company's main auditor or another qualified person. But for a branch outside India, it can be audited by the company's auditor or an accountant qualified under the laws of that foreign country.
Adherence to local professional standards is key.
It is. The branch auditor then reports to the company's main auditor, and all the fraud reporting provisions extend to them as well.
Now let's look at how the auditor leaves, specifically through removal, resignation, and casual vacancies.
So if the auditor's position becomes vacant midterm, It's a casual vacancy under Section 139(8), and the filling process is determined by the cause.
For a standard company, if the vacancy isn't due to resignation.
The board fills it within 30 days. The appointed auditor holds office until the conclusion of the next AGM.
But if the vacancy is caused by the auditor's resignation, the law treats this differently and introduces a shareholder check.
It does. The board still fills the vacancy within 30 days, but their appointment must also be approved by the members at a general meeting.
And that meeting has to be convened within 3 months of the board's recommendation.
Yes. Example 9 shows the timeline. If the resignation is October 31, the approval meeting has to be held by the end of January.
And if it's a government company dealing with a casual vacancy?
Oversight reverts to the CAG. The CAG has to fill the vacancy within 30 days. If the CAG fails, the board gets the next 30 days.
Let's return to the deliberate termination of the relationship. Removal of auditor before term expiry under Section 141. This seems like the ultimate test of regulatory friction to protect the auditor.
The system is designed to prevent management from firing an auditor just because they delivered a critical report. It requires a highly regulated two-step process.
What's the first step?
First, the company must get the previous approval of the central government, which is delegated to the regional director. They have to apply in Form ADT2 within 30 days of the board resolution proposing the removal.
And the second step?
Only after getting that central government approval, the company must pass a special resolution by the members in a general meeting held within 60 days of getting the CG approval.
Wait, so even if the board and 99% of shareholders hate the auditor, they still have to get permission from the central government first?
Yes, that bureaucratic hurdle, that procedural friction, is intentional. It ensures the decision is reviewed externally by a regulator to confirm it wasn't arbitrary or punitive.
And Example 10 confirms that removing an auditor without that approval is legally invalid.
Completely invalid. It's a contravention of the Act.
And the principle of natural justice must always be observed.
Absolutely. The auditor must be given a reasonable opportunity of being heard before any removal action is finalized.
Finally, the auditor initiating the change. Resignation under Section 142. What are the auditor's filing obligations?
The duty doesn't end with sending a resignation letter. The auditor must file a statement in Form ADT3 detailing the reasons for resignation with the company and the Registrar of Companies within 30 days.
And if it's a government company?
That filing must also be made to the CAG.
And failure to meet that 30-day deadline?
The penalty is immediate. 50,000 rupees or an amount equal to the auditor's remuneration, whichever is less.
Let's turn our attention to specialized compliance first. The cost audit requirement under Section 148(1). This isn't about the financial statements, but about the underlying production costs.
This applies to companies engaged in the production of specified goods or services. These companies must include cost records in their books if they are doings. Overall turnover from all products and services is 35 crore rupees or more during the preceding financial year.
Who is exempt?
Micro or small enterprises based on the turnover criteria defined under the MSME Act are typically exempt.
If the central government directs a cost audit under Section 148(2), what's the mandatory professional requirement?
This audit is strictly in addition to the statutory financial audit. Only a cost accountant in whole-time practice can be appointed as the cost auditor.
And we must ensure the separation of roles we discussed earlier holds here too.
Crucially, yes. The statutory auditor appointed under Section 139 shall not be appointed as the cost auditor and vice versa.
Illustration 15 confirms this hard line.
It does. Even if an LLP has both CAs and CMAs as partners, it cannot hold both appointments for the same company. The independence firewall is mandatory.
The cost auditor reports to the board, and then the information must go to the government.
Correct. The cost audit report goes to the board, who must then furnish that report along with any necessary explanations to the central government within 30 days of receiving it.
Now for the final accountability layer, penalties for contravention under Section 147. These penalties really define the severity of breaking these independence and duty rules. What is the baseline penalty for the auditor found in default?
The fine starts at a minimum of 25,000 rupees and goes up to a maximum that is the lesser of 5 lakh rupees, or 4 times the remuneration received.
So the financial consequence is immediately tied to the benefit they received.
Immediately.
But the penalties escalate dramatically if the auditor's failure is knowing or willful with an intent to deceive.
This is the law defining a betrayal of public trust. If the contravention is knowing or willful, the auditor is liable for imprisonment up to 1 year, and a fine That is the lesser of 25 lakh rupees, or 8 times the remuneration.
That jump from 4 times to 8 times remuneration really signals the regulator's zero tolerance for intentional deception.
It does.
And if they're convicted, the consequence isn't just a fine. They have to repair the financial damage they caused.
That's the liability provision. The auditor is liable to refund the remuneration received and, more importantly, they must pay damages to the company, members, or creditors for any loss arising directly from incorrect or misleading statements in their report.
In cases involving an audit firm and fraud, what about the liability of the partners?
If fraud is proven, the liability falls jointly and severally upon the firm and the specific partner or partners concerned.
So they are all individually and collectively on the hook.
Yes, civilly and criminally. Partners cannot hide behind the corporate veil of the firm when professional misconduct leads to fraud.
Finally, let's revisit the apex body ensuring quality control, the NFRA, National Financial Reporting Authority. What are its sweeping powers over auditors of large entities?
NFRA acts as the ultimate monitor. It has the power to oversee compliance with auditing standards for large, governed entities, ensuring consistency and quality control at the top end of the market.
What's the ultimate expression of NFRA's oversight power?
They can require the auditor's personal presence for explanations, and most invasively, they have the power to review audit working papers.
The actual detailed documentation.
Yes, the audit plan, the controls, the testing, they evaluate the auditor's quality control system and can direct auditors to take specific measures for improvement. This ability to scrutinize the raw working papers is the highest level of regulatory intervention.
This sounds like a system designed to catch professional failure before it escalates into the level of corporate fraud we saw in previous decades.
It is exactly that. And it culminates in NFRA oversight, requiring auditors of governed entities to file an annual return in Form NFRA 2 by November 30th every year.
Providing continuous quantitative data on the audit market.
And the quality being delivered.
So we've established the full legal landscape governing these corporate watchdogs, from mandatory rotation after 10 years and the absolute prohibitions on holding client securities to the strict requirement of central government approval for removal and the high-stakes procedure for fraud reporting. This framework is a legislative monument to the lessons learned from decades of corporate failure.
I agree. The law is designed to isolate the auditor, arm them with immense power, and then hold them accountable through very quantifiable penalties.
If we connect this wealth of detail to the bigger picture, the sheer microscopic nature of the regulation, the 1 lakh limit for a relatives holding, the mandated audit log on accounting software, it all points to a regulator obsessed with closing every technical loophole ever exploited in corporate fraud history.
You're right. The legal focus has clearly moved from reacting to failure to enforcing systems that provide continuous, predicted accountability.
That brings us to our final thought for you to chew on. We've defined the independence firewall under Section 144, listing the 8 services an auditor cannot render. Yet major audit firms possess the unparalleled expertise needed for complex tax structuring, valuation, and M&A advisory services their large clients desperately need for success. What stands out to you is the inherent tension. How does a firm leverage its deep specialized knowledge to create immense value for clients without breaching the absolute legal requirement to maintain pure, objective detachment when verifying historical truth? That delicate, difficult balance between value-add and non-negotiable independence is what continuously defines the modern field of corporate governance.